um, Good afternoon. Welcome to the Business Podcast. I'm Nikki Larkin. Today, I'm delighted to be joined by Richard Feakins. Hi, Richard.
Hi, Nikki. Hi, everyone.
So, today's topic is navigating the UK corporation tax rise. So we're going to go into detail about that, try and help you out with some things that you need to be looking out for, etc. If you're new to the Business Broadcast and it's your first time watching, please do say hi in the comments, and also please feel free to ask questions as we go along. No such thing as a silly question. It's more silly not to ask a question and then go and mess up your taxes. So please do ask, and we will endeavour to hopefully answer your question, or be able to come back to you if not, if it's too much of a long one. Anyway, so there's a lot to cover because the changes are, well, I think quite vast, especially for SMEs that are going to see this happening. So, Richard, what are we talking about today? What are the changes, and why? So, what are the changes to start with?
The main change that everybody's, if you like, fixed on is the corporation tax increase to 25%. It doesn't apply to everybody. Profits up to 50% will still be taxed at 19%. Profits above 250 will be taxed at 25%. Profits in between have a tapering adjustment, so they gradually increase up to the 25%. But the simplest way to look at it is just to say, first 50,000, 19%.
Okay.
Next chunk up to 250,000 at 26.5%.
26.5.
And then above 250,000, 25%. So that's the main change, the highlight change. But there's a very important change coming in at the same time around how those limits are calculated and when they're relevant, when you have groups of companies and companies under what we call common control. The common control test is new from the 1st of April 23 and will have an impact on those limits.
Okay, so that makes it all even more complicated, a whole nother raft of calculations that we're going to have to think about. Our spreadsheet skills are going to have to increase. So can you just firstly go for the mechanics of the calculation for a relatively simple business?
Okay. If your year end happens to be the 31st of March 23, that's incredibly simple. Your profits are going to be taxed at 19%.
Okay. Okay, so it's the ones that are about to close, all at 19%. So we don't have that. We're about this headache till next year if you've got March year end. Okay, right.
If your year end happens to be the 30th of April 23,
which there will be,
you've got a straddling. You're 1 month into the new regime and 11 months in the old one. So you have to do an apportionment of your profits to work out whether or not that 1 month worth of profits is going to be taxed at 19, 26.5 or 25%.
So, right. So if I've got, let's think of trying easing up. So you've got a 30th of April. We're going to be testing on mental arithmetic today. If you've got a 30th of April 23 year end, The net profit is 120,000. Therefore, pro rata, 120 divided by 12 happens to be 10. So you've got 10,000 into the new regime. Do I then do 50 divided by, do I need to pro rata it again?
Yes.
Okay, so it's not, oh, it's only 10, it's fine because it's under 50. No, you've got to do 50 divided by 12 to see, are you, and yes, 50 divided by 12 is less than 10, therefore you're straddling over into the 26 and a halves.
Yeah, exactly.
Oh, okay. So we're going to be, I'm not going to apologize for saying this multiple times today. If you have a limited company, because this is affecting limited companies, not limited LLPs, not partnerships, not sole traders, you're still all fine. This is affecting limited and even limited partnerships, because we have some LPs too, but limited companies, that's who this is affecting. So okay, so we're going to go through in a little while, so stay tuned, because this, we will be talking about some tips to try and delay worrying about it, or potentially save money, or both, in fact. Okay, so my April year end, I've got some straddling over. Okay, that's fine. We can work that out. It's not actually too bad. I might even be able to work that in my head. But the next complication, I've got 2 companies. Then what happens, Richard?
If you've got 2 companies, that 50,000 limit at 19% is reduced to 25.
50 divided by 2. Yep.
So if your profits were 30,000, you'd have 25,000 at 19% and 5,000 at 26.5.
Okay.
Now, when you say 2 companies, this, under the current rules, that would be where one company controls the other. So under the current rules,
a holding, I've got perhaps a trading company and then a subsidiary which is also trading.
That's right.
Okay.
If you have a mere holding company that's not doing anything, it's passive, it just receives dividends perhaps from a subsidiary, you can ignore that holding company.
Oh, that's useful to know. Okay, so but it's got to be a true holding company.
It's got to be a true holding company.
Yeah, not one of these ones, I'll just stick a bit of revenue through. A true holding company.
Absolutely. Okay. Absolutely.
Okay.
So those are the current rules. But what we have to watch out for is that from the 1st of April 23, those rules about associated companies are modified to include companies under common control. So if you have a very wealthy individual that owns all the shares in a trading company, which has a subsidiary, that's straightforward. We have 2 associated companies. But that wealthy individual may also own an entirely separate company. And we then have to bring that one in. So
it could be a sister company. It's not actually linked, but because it's got the same shareholding.
Common control.
Okay.
So there we have 3. The good news is that because those common control rules only come in from the 1st of April 23, and you look back at the previous 12 months, we're not going to have to worry about that until a year's time. So we've got a year to look at entire groups and group arrangements and associated and companies under common control
Okay.
and work out which ones do we need, which ones we don't need. Do any of those common control companies benefit from exemptions? Because there are some exemptions.
Oh, okay. Well, let's come to the exemptions in a little while. I've got a couple of questions coming in. I've got loads flying around my head as well, but some of these will probably cover it. So Nigel asks, and I think we covered this, but we will just repeat it to be clear. The percentage changes and when they're being introduced. So the changes in the percentage is from
1st of April.
Yeah, it's the unlucky April Fool's Day. 1st of April 2023.
That's right.
And the percentages are going to be, so let's see if I've been listening. Test my listening skills today. Under 50,000, if your profits are under 50,000, you're okay. You're still at 19%. If your profits are between 50 and 250, you have your first 50 at 19%, but the rest of it at 26.5%.
Yeah.
If you actually have profits over 250, you are at 25%.
That's right.
Okay. Nigel, hopefully that's answered the question on that one.
If your profits straddle the 1st of April, you apportion for the pre and after.
Yeah.
If you've got associated companies, you'll reduce that 50,000 and 250 by the number of associates.
Yeah.
But also bearing in mind that we need to be reviewing companies under control for the next accounting period.
Okay, Fanny's got a great question, which I'm going to come to in a second. I'm just going to throw another one in. So if I've got, I don't know, X amount of companies, but then I've also got one that's got a loss in, those losses can offset the total for what we're calculating.
Yeah. The normal group loss relief rules apply.
But that's if you group them. So you could have. So that could be a reason why wanting to group, because if you haven't got them grouped, you could end up with your profitable ones over the 250, and you're not actually using your losses. Okay, that's we need to
that's a really good point. That's a really good point, actually. You could have companies that are associated, but under the current rules, to be associated, they would be groups.
Yeah.
So you would get group loss relief. But going forward, you may have companies under common control where group loss relief is not available. And you could have one making a loss, one making a profit, but the limits are still reduced by 2.
Okay.
In that scenario.
Right, let's go to Franny. She always has great questions. Franny, so does the ownership need to be exactly the same for companies under common control? And we talked about this before we came on live. So do you want to address that question, Richard?
So common control is very broadly who has the majority voting rights. It can also follow shareholdings, but generally it's who has the majority voting rights. So if you have a company where the voting rights are held by Mr. A, the majority, and you have a separate company and the majority voting rights are held by Mr. A, they will be under common control. As straightforward as that.
Okay.
I hope that answers the question.
Okay. I'm sure, Franny, you have a follow-up, so we'll look out. So where are we? Yeah. So one there was something that in a scenario that I discussed earlier, which is worth putting out there. So you've got to be very careful of what you may end up being a shareholder in multiple different group treatments for this. So, for example, I was saying, you might have some companies that you own. Franny, this is exactly what I'm coming on to. She's reading my mind. 50-50 voting rights. Correct. They're not coming. Exactly what I was coming on to. So, yeah, so what we're talking about, if you've got...
I think, though, knowing Franny, though, and having a broad awareness of their situation, husband and wife will be common control.
Oh, okay. So if you have a company, but if you have, for example, so you have a company where you own 100% of it. You might have other ones that you own 100% as well. They all get calculated together and you pro rata. Hopefully you are over 250 anyway, then who cares? You're at 25%, you are, because it's great, you've got lots of profits. If, however, you haven't, you do all the pro rating. If, however, separately, you may have an investment in another business where you own 50%.
Together with your spouse.
But if you have like a business husband, like Mr. Nigel Elks, those are not in the same grouping. So he might have some groups in 100%. I've got some in 100%, but our 50-50 ones, that's a whole separate group.
Yeah. So common control does include those controlled by yourself or your associate. And an associate for those purposes would be a spouse, for example, close family member. Doesn't include children.
So if your children's got shareholdings, that's not, they are...
As long as they're adult children.
Over 18. Okay. The key thing, right, I'm going to put in another... People, you need to be asking Richard some more questions that aren't too complicated, because I'm going to do another... We need to get on
to some tips.
Okay, yes, let's get on to the tips, and if we have time, come back to some more other left field questions. Okay, so we've worked all of this out. What can we do to either delay this issue or reduce the cost of this issue? What practical steps can we take, Richard?
Okay, well, the first obvious one is, if you have a company with a year end that is straddling the 1st of April. So let us say your year end is July.
Okay.
July 23. So you're going to have some profits falling in the old regime and some profits falling in the new. You may be a business with very cyclical profits. So, for example, you might make most of your profits over the Christmas period. In those circumstances, it would probably make sense to look at shortening the accounting period to the 31st of March to ensure you get the maximum profits in the earlier period, charged at 19%.
So, for example, I've got, I've got loads of different clients, but for example, a group that might have all 30th of April year ends, and they're absolutely going to be hit by the 25%, no question. It could be potentially worth them shortening to 31st of March, because that is going to have pounds and pence savings.
Yeah. The other thing to look at is how losses are used.
Yes. Right. Take me through that.
So if you under existing rules, you can carry back your losses generally for a year. Instead of carrying them back against a 19% tax rate, you might want to carry them forward into a 25% tax rate. Now, I understand there are going to be cash flow issues with this, potentially, but weigh that up against the 6% increase and see which one makes sense.
Yeah, so I mentioned about if you've got a company that's got R&D tax credits and you were thinking of cashing them in, but you're soon going to have profits, I really do recommend don't cash them in, take them forward, because you will save on pounds and pence. We've had another question come in, Richard, if we can squeeze. And it should be just clarifying what we're talking about, the 50-50. So Jamie, hi Jamie, I don't think we had a question for you before, so welcome, thank you very much. So the question is, so husband and wife with 50-50 is common control, he's quite asking. One party, however, has a second limited company as a sole director. They have additional tax liability.
Potentially, yes, but there is a get out, if you like. If the two businesses are what we call substantially commercially independent of each other, then you don't count them. So if, for example, one is a recruitment business and one is an engineering business, and they don't really interact with each other, they have different customers, they're doing different things, then you don't count them.
That's one of the best tips towards the end there. So anyone that's listening now still, absolutely, that's a great one. So if you have got a diverse portfolio of interests, you've got to be very clear on, are they part of the same thing or not? And if they're separate, clearly, you know, if it's a shoe shop and you've got also a hairdresser's, they're different.
Yeah, exactly. Exactly.
Okay, good. Okay, that's very clear. I hope that's helpful, Jamie, and please do ask more questions. We love them. Okay, so mitigating. So we've talked about mitigating so far. We've talked about potentially shortening your year end to March, or even before that. We still could shorten it to February if you want.
You could.
Don't know why.
Don't know why.
Oh, we like Jamie. Jamie can come again. Priceless piece of advice. Thank you. Definitely come again.
Thank you,
Jamie. Right. So the question. So it's change the year. Potentially change the year end. Look at don't take losses back. Take them forward. Often a cash flow consideration.
Yeah.
R&D credits. Take them forward rather than cash them in. Again, often a cash consideration. Okay,
absolutely.
Really good
but there's a big differential now. I mean, I know that typically if you had a repayable tax credit, you would take it. If you generated a loss, you take the repayable tax credit on R&D at 14.5%. Not much of a differential there between the 14.5 and 19, so people would take it. I get that. Big differential now between that 14.5 and potentially 25, or 26.5 if your profits are over the 50 and under the 250.
Yeah, I've got a big R&D one that really need to be trying to persuade them to take them forward rather than cash in next time. Definitely.
Yeah.
Okay. So it does sound like, so there's lots of different things to consider. What things do you think people should do? I know what I think they should do. Talk to you or their accountant and plan ahead. But what proactive things? What should they do as of this minute?
As of this minute, look at whether shortening the year end makes sense.
Yeah.
Not just for the new corporation tax, but also potentially for the capital allowances super deduction.
Yes. Mm-hmm.
because bear in mind that stops as at the end of March. And if you have a year end straddling March, you'll lose some of that super deduction.
Yeah.
Because it will be prorated.
Yeah.
The other thing to look at doing is do an analysis of what companies you have in place.
Mm-hmm.
So we've got a year or close to a year to look at whether those other companies are under common control, whether they or not they need to be brought in to this new calculation, or whether they're exempt because they're totally independent of the businesses we're looking at.
And also look at, why do you need all these companies? I often see sometimes people have got carried away with huge amounts of SPVs and things, which in some circumstances are completely right, but sometimes they're just crazy. So, for example, we're doing a big rationalisation project at the moment because we've got a client that has got a load of SPVs. At one point they had a purpose, but now then they're semi-dormant and they need to all close down. So don't hold on to companies. All it does is cost more admin and time and things. Not that I want to do accountants and tax people out of fees, but do look at your rationale of why have you got so many companies as well. Just highlighting again your super deduction point, Richard. Franny has made the comment, and obviously hold as many costs as possible until April. So what we're saying is not, obviously legally doing it because you're just not buying them, so you don't have to incur them. However, if it's a capital expenditure cost that gets super deductions, it's still probably worthwhile getting them now, but do the calculations.
Yeah.
If it's normal expense type things, absolutely. Look, just wait until you send everyone off on a training course and do it in April, not March.
And conversely, pull forward any revenue you can.
Yeah, get those deals done. Get them done in March.
As always, there is a trade-off between cash flow and the new tax rate. It's always been the same.
I suspect nobody's earning huge percentages of interest on that, keeping the cash in the business anyway. So it's still, I haven't seen any big bonds or anything deposit accounts coming through for businesses, even though the interest rates keep coming up.
Do we have time, or is anybody interested in the quarterly installment payments?
Let's put it in as a bonus feature. Let's do it. Bonus feature, quarterly payment regime changes.
So the two changes coming in are the obvious one, the rising corporation tax rates. But the second one, as I mentioned, is the change in the number of companies that you have to consider when you're looking at the limits for the corporation tax. But those changes also have an impact on the quarterly installment payment regime. So just a very quick recap. If you're a company making profits in excess of 1.5 million, you pay your corporation tax in 4 quarterly installments. The first one 7 months after the start of the accounting period. A normal company doesn't pay its tax until 9 months after the end of its accounting period. So if you're in the quarterly installment payments regime, your cash flow looks very, very different. With the new control criteria for associated companies, more companies may be brought into the quarterly installment payment regime, which will have a massive impact on cash flow, because you're going to be paying your corporation tax 9 months after the end of the previous accounting period, and your first quarterly installment payment 7 months after the start of the next accounting period.
Wow.
So,
and of course, we want to have £1.5 million profits. Everybody wants that,
but you could
you know,
have
it is,
4 companies,
soon
5
adds up.
companies making 250, and suddenly you're in that regime, and
Indeed.
they're all in that regime.
Okay, so big word of warning: do be completely aware about that quarterly. If your profits are, as soon as they're starting to go over £1 million, you need to start preparing and thinking, because before you know it, another deal goes up. So be careful. Was there another thing? Or that's a sigh of relief because we've managed to get everything out.
No. Was there anything else?
I think that was. I think that's everything that we went through.
Just a word of warning on dormant companies. When you're looking at these limits, you don't include dormant companies, but the meaning of dormant for most of us is, oh, it's hardly doing anything. But the meaning of dormant for tax is there is nothing going into the bank. It doesn't hold anything. It's not paying accountant's fees.
It's not doing dividend. It's not posting dividends. It's doing nothing.
Zero.
I have to remind a lot of clients about that. Oh, there's nothing going on, honestly. Actually. Yes. Okay. No, that's super. Brilliant tips there. Thank you so much, Richard. We do feel free to reach out. Definitely, I say talk to your accountant or your tax advisor now. Definitely start planning, so you don't have any nasty surprises and it's too late to do anything. But thank you so much, Richard. I already feel more conversant with it all. So that's super. Thank you so much.
Thank
you.
Have
a great day, everybody. Great afternoon. Thank you, Richard.
Thanks, everyone.